This is Robert. I hope you had a great summer. So, I want to take a few minutes to talk about the third quarter of 2025, really talk about the full year and also what we might look forward to for the next 3 months to wrap up 2025. So, it has been a tumultuous year, to say the least. We started the year quite strong, economy was looking good, and then we had spring. And if you recall, we had a lot of discussion about tariffs. Are they going to be positive? Are they going to be negative? There was a lot of discussion about sort of a change in world order in terms of the United States and how it deals with its enemies as well as its allies. And that period of time, the market dropped nearly 20% in a very, very short amount of time. And since then, the market has rebounded and rebounded quite strongly, actually. So you can see this is looking at um, as of the third quarter ending September 30th. You can see that just in the third quarter of 2025, this is not even the full year. This is simply 3 months, the third quarter. You can see across the board, assets did well. Some better than others, but across the board, things were quite positive. So you can see US stocks up over 8% in the last 3 months. International developed stocks still positive, and very strong returns for the year. But in the third quarter, international did lag U.S. stocks by about 3 percentage points. The big move, not just in the third quarter, but this year, has been emerging market stocks. They're up nearly 11% over the last 3 months. Real estate, positive. Bonds, very nice return for bonds in a 3 month period. You don't normally see a 2% plus return in a short period of time for the bond market. And so, all in all, very, very strong third quarter. So, we can see this is looking at the past 12 months. And I always love putting this slide together because it just illustrates, I think, that if you're focused on headlines in the press, if you're watching videos, watching the news, whatever it might be, that it can really cause an investor to be quite anxious. And of course, that's what they're selling. Uh, they're trying to get your attention, and they do that by creating very, very scary headlines that induce anxiety and fear, because they know, of course, that's going to get you back and get you to keep reading. And the problem with that is, of course, there are many problems, but when it comes to your money, oftentimes those scary headlines will cause someone to want to then change their approach. Um, and usually that's a bad move. We put together these portfolios and these allocations because they make sense. They make sense in the short term, they make sense in the long term. And if you are consistently reading things and getting nervous and then wanting to change the approach, that can only hurt your returns. And I'm sure you've heard me say this before, but my joke is that if you want to become a millionaire investing in the stock market, well, all you have to do is start with $1 billion and then try to time the market, because that billion will very quickly be reduced to a million. So, trading the market, trying to get in and out based on what you read or what you see, is a losing strategy. So we can see here that this is what I was referring to a little bit earlier, where we had the start of the year. Here, things were going nicely, and then we had tariff talk. Tariff talk, markets did not like it. There was a tremendous amount of uncertainty. just didn't know how far or how wide or how deep the tariffs would go. And that was a painful period. But as I mentioned then, I was really cautioning people to make big, broad decisions and changes because my expectation was that it would get worked out, that all in all, that tariffs wouldn't be such a negative event, and that the markets, once they really read through the headlines and settled, that we would see strong returns again. And you know what? It did not take long for us to not only recover from these losses, but then start the ride higher. And that's exactly what we did. But during that time, I mean, look at this headline. Again, I didn't make these headlines up, these are from actual publications. This one was Stocks Extend Tumble as Trump's Tariffs Spark Retaliation. Well, that sounds pretty scary. How about this? Tech shares lead stock slide as recession talk roils markets. Boy, roils. They love that word. And then we've got, how about this one? Trump unveils sweeping tariffs in stark shift in US trade policy. So these, you read these and you're experiencing it at the time, and this is only going to cause you to want to make a change. And so, while, of course, if you want to read the news, if you want to watch the news, of course, by all means, do it. But when you do, when you see a headline or you hear something, just remember this slide right here. Remember that we often see these headlines, but the markets are very forward looking, and over time, they tend to go up. So we can see, let's just look at, again, third quarter US stocks. So there are different types of US stocks. They're small, they're large, they're value, there are more growth oriented US stocks. And so let's see how each of these did over the last 3 months. You can see, look at this, the top three right here: small value, small blend, and small growth. Small companies did better over the last 3 months than large. I love to see this. This is a fantastic sign because what we've seen over the last many, many years is large companies outperforming by a significant margin smaller company stocks. And so by seeing small companies start to do better, that is a broadening of the returns and a broadening of the bull market, which is very positive, not just for small companies, but also for large companies. So this was a great thing that happened over the last 3 months, and I hope it continues. So we can also look at, again, not a whole lot to talk about on this slide, but just something to sort of keep in the back of your mind. This is going back from the 70s to today. And what this shows is, from a very long-term perspective, 50 years, that the market has gone up over that time. Maybe not an exact straight line like I just drew. There were times where we had dips. Look at that. Remember Black Monday? I remember. I remember exactly where I was when I heard about that crash. You remember the tech crash? Lived through that. That was a painful period. Or how about the financial crisis? I still remember exactly how I feel during that period. Those were some dark days. We also had the pandemic. We all remember that was only just a few years ago. So it's not as if the market every day, every week, and every month, and every quarter, and every year, it's positive. We will see declines. There is no question about it. The most recent was just this year, nearly 20% drop. But over time, if you stick to a strategy, stick to a diversified portfolio that makes sense, you are likely to go up over that time. And that's exactly what we've seen. This is one of my favorite slides. And just as a reminder, what you're looking at here is each of these bars represents a year and the return for the S&P 500 for that particular year. You can see any blue bars above this line that I'm drawing. So above this line for positive, and any blue bars right here, 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 and here below this line for a negative return. So first thing that you'll notice that there are significantly more blue bars above the line than below the line. What does that tell you? It tells you that on average, the market produces a positive return for the year more often, more frequently than a negative return for the year. So that's the first thing. The second thing you'll notice are these red dots. What are all these red dots mean? Well, the red dots represent that in a given year, the red dot is how far the market was negative for that particular year. So we can see let's look at 2020. So this was the year of the pandemic. So you can see that at one point, the S&P 500 was down 34% in 2020. It was actually in March. But then what happened? Well, you can see that this blue bar is above the line. The market in 2020, the S&P 500 was actually positive, was up 18%. That is a 50% swing from negative 34 to a positive 18. And this doesn't just happen once in a while. It didn't just happen in 2020. It happens almost every single year. It is rare where the market isn't at one point negative during the year and then ends positive. For this year, in 2025, the market was down 19%. 19%. We were negative for the year. And what are we at now? Up 16% for the year. So that should also tell you something. Not only is the market more often than not positive for the year, that's these blue bars, but that there is volatility and that it's often negative at some point. But if you stick to the strategy, stick to the asset allocation, then more often than not, you will be positive for the year. So that is something to consider and keep in mind during volatility. Speaking of, these are the number of times the S&P 500 pulls back 5% or more in a particular year. So you can see this was a absolutely ridiculous period of time, right? We had the financial crisis, lots of volatility, tremendous amount of swings of 5% or more in that particular year. Where are we in 2025? Oh, we're at 5 times. What is the average number of times the market pulls back 5% or more? Right here, 4.6. So we still have 3 months to go, but this year is more volatile than the last couple of years, but it's not significantly more volatile like we've seen in years past. It just means the market will absolutely be a roller coaster. It always has been, it always will be. There are periods where it feels like an e-ticket for all of you who remember Disneyland and their e-tickets. That was the most wild of the rides. But there are also periods where it is very low volatility. Just something to keep in mind. So here's another slide that I really like, especially when there are some disparities. So you can see that this darker blue line here, what is that? Well, that represents the S&P 500, the return. See how that changes. And this blue, light blue shaded area here, this represents earnings per share of the S&P 500. And what's really interesting is when you see a big gap between the two, because day to day, anything can drive what the S&P 500 does. A tweet can drive what the S&P 500 does for that particular day, or even that week or that month. But over longer periods of time, what really drives the stock market is corporate earnings. How much are companies making quarter after quarter after quarter? The more they make, the higher the growth rate. Generally speaking, over time, the higher the market goes. So when you see large divergences, so look at this. So this is S and S&P earnings, very, very high, market not so high. Well, that's interesting. How about here? S&P quite low, earnings quite high. When you see the divergence between these two, only one of three things can happen. Either the earnings can drop to meet the S&P can rise to match earnings, or a combination of the two. So right now we are right in line. Earnings as well as the S&P 500 index are right in line. There will be a period where the earnings are much higher than the market, or the market is much higher than earnings. These can be opportunities. And it's something that I've talked about. If you go back a couple of videos, when we were here, I was saying that one of three things could happen: that earnings are going to drop to match the S&P, or that the S&P is going to go up to match the earnings. And that's exactly what we've seen happen. So let's talk about the future. We've talked about the past. It's been a great year. It's been a great quarter. What about going forward? Well, this is an interesting slide because what it represents are leading economic indicators. So imagine if you had a crystal ball and it would always tell you where the market was going to go. That would be amazing, right? Well, sadly, we do not have that. But what we do have are what they call leading economic indicators. These are things that we point to, and we try to figure out what the future will hold based on these indicators. And generally speaking, they're fairly accurate. They're not accurate to the day, of course, of when you might get a recession or when you might see growth, but they tell a story. And over time, what you'll see is that when the leading economic indicators are negative, and these are these orange bars here, when they're negative, then what happens? Well, then you'll often see these gray bars. These are recessions that we've had. So if all the leading economic indicators are pointing to slowdown and trouble, then what that usually means is we're probably going to see some kind of a recession. It happened here, it turned negative right here, and we got a recession. The leading economic indicators turned negative, recession. Turned negative, recession. Negative, recession. Turned negative, recession. Turned negative right there and got a recession. Look at where we are now, though. Leading economic indicators absolutely turn negative. There is no gray bar yet. I'm not saying that there won't be a gray bar, which means there won't be a recession. But at this point, there has been no recession. We saw a sharp contraction here, and that really, if you look at it, was the result of a lot of the factors that came from the pandemic and the government's response: inflation, uh, unemployment. That's why you see this be so negative. So this period could have been artificially created by a lot of the things companies and the government did back during the pandemic. So where are we now, though? We saw a sharp decline in leading economic indicators. It's now since risen. The question is, what's next? Well, let's take a look. Unemployment rates. Unemployment rates are very important. What you'll see is that unemployment during the pandemic obviously skyrocketed. When people could not go to work, you saw unemployment increase. It has since decreased, but what are we seeing here? We're seeing an uptick in unemployment. I think it is possible and probable to see unemployment continue to creep up. There are lots of reasons for this, including artificial intelligence. We're already seeing many companies talk about how they're implementing AI and are getting by with fewer people, or implementing AI and actually laying off people. And we are at the beginning stages of, I think, a massive change in the economics and the employment of our economy because of AI. If you think about ChatGPT, if you're not familiar with it, it is basically an AI tool that is extremely powerful, and there are many others now. But ChatGPT was really the first one of its kind, and that's only a couple of years old. And we're already seeing massive investment into AI, into data centers, into these LLMs, into agentic AI systems. We are really at the beginning stage. And if you're a baseball fan, I would say that we are likely in the first inning, second inning of a 9 inning game. And we are just now starting to see some of the ramifications of AI, both positive and potentially negative. If employment continues to increase, that could be a drag on the economy. At the same time, if companies and employees are more productive, doing more with less, that could be a very positive for corporate earnings and for asset holders. And that's a big key. It's really separate, a completely separate topic. But if people do not have assets, they're going to be left behind. The only way, I think, we are going to not just survive but thrive in this new this new economy, you have to own assets. And so that's the big takeaway, especially for younger people. What I'm telling them, they must own assets. It's more important today than it ever has been. The other thing that we can look at, in addition to unemployment, but the labor market, we can look at inflation. So CPI is a measure of inflation. You can see that post-COVID, we had massive inflation, and that has since come down. The Federal Reserve has, over that period of time, increased interest rates very, very high, and that is done exactly what they wanted it to do. They wanted to bring down inflation, which they have. You can see here that it's come down, it's ticked back up. That's worrying some people, but what I would point to is that for the CPI, for inflation, we are seeing lower lows and lower highs. So that's a low. And then it ticks up, and then it came back down. I don't know if you can see that, to a lower low. So this low is lower than that low. That's a good sign. This high is lower than that high. And then we drop back down again. This low is lower than that low. This high, at this point anyway, is lower than that high. So what that means is it's trending down. We hope that continues. We do not want to see an uptick in the CPI or inflation, because we have a Federal Reserve that has started to ease interest rates. They're lowering interest rates. They're doing that because inflation has come down. If inflation was still elevated, they would not have the ability to lower interest rates. We like lower interest rates. It's good for financial assets. It's good for your investments. It's good for the economy, means people can get cheaper car loans, cheaper mortgages. It's overall, it is a catalyst for growth. So we like that. So if you have any questions about the slides I went through, CPI, the employment, AI in particular, or the asset allocation, outlook, whatever it might be, if you have any questions, please reach out. I would love to talk to you. I love this stuff more than anything and would love to talk to you about it. So until next time, I hope you have a great fall.